When making business decisions, we like to think that managers and investors are risk adverse. And that means there's a relationship between risk and return. For a given level of risk, how much return is acceptable to an investor? So we can illustrate this by a simple coin flip. Suppose you're offered these three choices on a coin flip wager, and we're going to assume that it's a fair coin, it's not loaded or anything like that. Choice A, if it lands on heads, you will win $1,000, and if it lands on tails, you lose $500. Your average or expected payoff then is going to be 0.5 times $1,000 plus 0.5 times a minus 500. The 0.5, it's a 50-50. 50% chance it lands on head, 50% chance lands on tails. So your expected payoff is $250. Choice B, that wager would be heads you win $250 and tails you win $240. Your expected or average payoff is, again, 50% chance it's heads and you win $250 plus 50% times the $240, 50% chance that it lands on tails and you win $240. So your expected payoff is $245. Or the third wager, choice C, heads you win $10,000 and tails you lose $9,900. Your expected payoff is, well, 0.5 times the $10,000 plus 0.5 times the $9,900, or $50. Which would you choose? Well, it depends on what type of investor you are. Economists use three categories to describe how investors respond to risk. A risk-neutral investor is one that has an attitude towards risk in which they'll choose the investment that has the highest return regardless of its risk. So which one of these has the highest return? That's choice A. It has an expected return of $250. Choice B, an expected return of $245. Choice C, an expected return of $50. So if you were risk neutral, you don't care about risk, you're looking at which one of these gives you the highest expected return, and that would be choice A with the $250. A risk-adverse individual is one with an attitude towards risk in which they would require an increased return as compensation for an increase in risk. So risk-adverse, for a given level of risk, you want to try to get the highest return. But if you're going to take on more risk, you expect to get a higher return. You're going to require a higher rate of return to compensate you for taking on an increased risk. And we look at choice B. Now, it doesn't offer the highest return, right? It's $245 versus $250. But can you see that for a given level of return, about the same, $250, $245, the risk is much less? In fact, with choice B, you're not going to lose. You're either going to win $250 or you're going to win $240. Whereas with choice A, you could actually lose some money, right? So choice B gives you almost as good a return as choice A. Expected payoff gives you almost the same expected payoff, but you have much lower risk. Now, we have to keep in mind these are the expected payoffs, right? We're not actually going to get $245. We're either going to get $250 or $240. That's the risk. Whereas choice A, we can see that that's riskier, right? Because you may win $1,000, but you could also lose $500. Losing $500 is much greater downside risk than choice B, winning $240. So if you're risk adverse, you will go with choice B. And then the third type of category is risk-seeking, and that's the attitude toward risk in which investors prefer investment with the greatest risk, even if they have lower expected returns. So look back to choice C. Wow, that's risky. You could win $10,000, and tails, you would lose $9,900. So the risk-seeking, they're looking for the one that has the highest payoff, $10,000. That's going to be the big reward. So a risk-seeking investor would choose choice C. So anybody that goes to Las Vegas or someone who buys lottery tickets, they're seeking risk, right? They're looking for the payoff. So you buy a lottery ticket, your expected payoff is you lose $1 or $2. Dollars or however much the lottery ticket is. But you're thinking about that really remote chance that you might have a really big payoff, even though mathematically buying a lottery ticket's not the smartest thing in the world to do. Risk is a measure of the uncertainty surrounding a return that an investment will earn, or more formally, the variability of returns associated with a given asset. If we look back to our coin flip example, we can see this variability. The variability for choice A is it's either upside of 1,000, downside of a negative 500. Choice B, the variability is from 240 to 250, and choice C, the variability is from a negative 9,900 to a positive 10,000. So the variability of choice C is the greatest, so we'd say choice C is the riskiest investment. Choice A has the next level of riskiness, a range from a negative 500 to a positive 1,000, and choice B has the least amount of risk.